ton of buzz around the 4+1 strategy in Toronto's real estate investing world right now. A lot of investors see it as the perfect solution: strong cash flow, big value add lift, and access to commercial financing that doesn't depend on your personal income. But are we rocking the boat if we say that it's not as good as it seems? Let's talk about it in this video. But before we do us a favor, hit that like button, subscribe for more real estate investing tips, and if you are serious about getting into the Toronto multiplex market, book that call with us. On paper, a 4+1 strategy in jumping into the commercial real estate space might seem like it's a no-brainer. You take a single family home and either build or convert it into a fourplex, a building with 4 self-contained units, and also build an ADU accessory dwelling unit in the backyard like a garden suite or a laneway suite. You end up with big rents, potentially a big lift in values, and to qualify for the mortgage, lenders focus on the property's income, not your personal income to qualify you. Sounds great for scaling, right? But here is the catch. That only applies once you actually have 5 units. The reality is investors cannot get commercial financing right off the bat. You still need to qualify for a residential mortgage first, which means that you still need to be qualified based on your personal income. And if financing for construction isn't set up properly from the start, the whole strategy can fall apart before you even get going. Another big risk with the 4+1 strategy is that it really only has one major exit plan: refinancing commercially through the CMHC MLI insured mortgage program. Many investors are assuming that they can refinance at 85% of your completion value, but CMHC isn't exactly known for keeping things steady, and they have made sudden changes before, and there's word that more might be on the way. For instance, conversion projects could now be treated as new construction, which means that you'd only be able to refinance up to 95% of your cost, not your completion value. But that is a huge difference and could leave you with hundreds of thousands of dollars still tied in the property as opposed to fully cashed out. So suddenly that refinance doesn't look as attractive as it once did. Now, even if refinancing goes as planned, the bigger question is whether these properties will actually sell for what the investors expect. On paper, we are assuming a 4.25% cap rate valuation, putting the value somewhere between $3.5 million to $4 million for a fourplex top-up plus ADU. But with so few 4+1s built and no sold comps to back up these numbers, it's really hard to say if buyers are actually willing to pay that price, and it could potentially be much lower than that. So instead of using cap rates alone to estimate your actual lift, you might want to adjust your expectations and use a much more conservative number. For higher risk projects, you would expect higher returns, right? But if those returns are a lot more uncertain these days with the 4+1, it actually does make more sense to go with smaller, more predictable investments like a triplex conversion plus ADU 3+1 or a duplex conversion plus ADU 2+1 instead. These projects give you solid value add lift on both the main house and garden suite or laneway suite still, but they end up taking less time and less money. You don't have to take on everything, the main house and the ADU, all at once, which does help you with lower capital requirements and better cash flow. You can start with the main house conversion first, refinance after it's done to pull out some capital, and then use that capital to build the ADU and then refinance again. We actually break down this exact process in this video right here, so feel free to check it out after this video. Now, since these are smaller projects, getting financing upfront for this ends up being much easier. And when it is time to refinance, it is also more straightforward. You can access up to 80% of the completion value based on real market sales. Yes, refinancing residentially always carries some risk because the market changes all the time, and your biggest risk comes in a falling market where lenders go off of market values instead of cap rates. But since mid-2022, Toronto prices have actually been moving sideways for the most part. And even with the tariff risk, even with the economic uncertainty, with interest rates likely trending down in the future, we would expect prices to either go more sideways or even eventually come up a little bit in a few years. And so that makes a residential refinancing a much safer bet compared to CMHC these days, where the rules can change at any time. Another big pro is that we have seen these 2+1s and 3+1s actually sell, and so we do have a solid idea of their real post-renovation value. With a 2+1, you're attracting a bigger buyer pool, not just investors, but also end users who might love the home that you built. That extra rental income from the basement apartment and that backyard house can qualify them for a bigger mortgage, meaning that they can potentially pay more for the house, and you might end up getting some really great lift for 2+1s. A 3+1, on the other hand, does mostly attract investors who are focused more on numbers and cash flow, and so the lift might not be as high as a 2+1, but you do get a solid balance between appreciation and rental income and cash flows. So the bottom line is a 4+1 isn't actually a bad idea, but it's not that magic solution that it's sometimes made out to be, especially with the higher refinancing risks these days and uncertain paper valuations. Sure, the absolute returns can still be much higher than a 2+1 or 3+1, but you are also investing a lot more initial capital, putting in a lot more time, and there's a lot more risk involved. And if the returns on the extra investment don't measure up, then it might not end up being worth it. With that said, if you are struggling to qualify for a regular residential mortgage, which is based on your personal income and debt, then a 4+1 could still be good for you. Once you have 5 or more units, you are refinancing commercially at that point, and these mortgages are qualified based on the property's income instead of your own finances. So what this does is it does make it easier for you to qualify for mortgages and can help you scale your portfolio faster. But if financing isn't the big issue for you, then take a closer look at 2+1s and 3+1s because they do offer solid returns with less risk. And if you are not sure what's best for your situation, let's chat. We specialize in helping investors make confident, informed choices when it comes to multiplex properties in Toronto. We focus on real data, not guesswork, so that you can be sure that you're making the right move. Whether you're looking for a fully renovated turnkey multiplex or you're looking for one that can be converted into a multiplex, we'll guide you through every step of this process. Here's how it's like to work with our team. We'll take the time to understand your goals, crunch numbers to find the best investment opportunities, and then help you land the right property for you. If you are looking to dive into renovations, we can connect you with trusted contractors and guide you through the entire process. Once the work is done, we can even handle leasing and property management too. Ready to get started? Just go over to this link here and let's chat.